If you're over 65 and you've never heard of the form that could hand you back $2,400 a year, the IRS is not going to be the one to tell you. There are 5 forms sitting on irs.gov and ssa.gov right now, free to download, that most people born before 1961 have never touched in their life. And every single one of them can put real money back into your pocket. Heads up, this is general information and not personal tax advice. And honestly, by the time we get to form number 5, you're going to wonder why nobody mailed you a postcard about this years ago. Let's clear something up first, because this is exactly where most videos like this one lose people. If you're living comfortably, you might assume this content isn't for you. It sounds like it's for someone struggling. If you're mostly living on Social Security, you might assume this is some advanced strategy for wealthy retirees with a financial advisor on speed dial. Both of those assumptions are wrong, and they're the reason so many seniors close this kind of video in the first 10 seconds and leave money on the table. These 5 forms apply whether you're living entirely off a Social Security check or you've got a pension, some savings, and a paid off house. The rules don't care how much you have. They care whether you filed the paperwork. Here's why almost nobody talks about this. None of these forms show up automatically. Your pension administrator doesn't call you and ask if your withholding is set correctly. Social Security doesn't send a letter saying, hey, you might be overpaying your Medicare premium. And a lot of tax preparers, especially the ones doing high volume returns during tax season, file the standard version of things because it's faster, not because it's better for you. Nobody along that chain has a financial incentive to bring these forms to your attention. That's not a conspiracy. It's just how a system built on opt-in paperwork works. If you don't ask, nobody offers. Think about a retired mechanic named Walter, 69 years old, living outside Columbus, Ohio. Walter spent 40 years assuming his tax situation was simple. Pension, some Social Security, standard deduction, done. He never once looked at whether his withholding matched what he actually owed, and he never appealed a Medicare surcharge that was based on income he hadn't earned in 2 years. By the time a family member helped him look into it, Walter had been overpaying by roughly $3,100 a year for 3 years running. That's not a rare story. That's the default outcome when nobody tells you these forms exist. And here's the part that catches people off guard. It's not that Walter did anything wrong. He filed his taxes on time every year. He never missed a payment. He wasn't careless. He simply never knew that a handful of adjustable settings buried in forms most people never open were quietly costing him money every single month. That's the difference between a mistake and a gap in information. Walter didn't make a mistake. Nobody handed him the information in the first place. This happens for a very specific reason, and it's worth understanding before we go any further. Most of the systems that touch your retirement income, your pension administrator, your IRA custodian, the Social Security Administration, are built to process paperwork, not to optimize your outcome. They apply a default. They wait for you to change it. If you never do, the default just keeps running year after year, quietly, without a single red flag ever being raised. There's no alarm that goes off when you're overpaying. There's no letter that says, by the way, you probably don't need this much withheld. The system is neutral. It's not designed to help you, and it's not designed to hurt you. It just runs on autopilot unless someone tells it otherwise. That someone has to be you. Now, where does all of this come from? This isn't guesswork or some gray area loophole. Form W-4P and Form W-4V are both official IRS and Social Security Administration forms available directly on irs.gov and ssa.gov. The senior standard deduction and the new senior bonus deduction come directly from the One Big Beautiful Bill Act, which Congress passed in 2025 and which the IRS has confirmed applies starting with the 2025 tax year. Form 8606 has been part of the tax code for decades. It's how the IRS tracks after-tax contributions to an IRA. And Form SSA 44 is published directly by the Social Security Administration as the official appeal form for Medicare's income-related surcharge. Every one of these is real, current, and free. None of it requires a lawyer. Let's go through all 5 one at a time in plain English. None of these require special software, a law degree, or a paid consultation to get started. Each one is a real physical form you can find with a simple search, and each one takes most people under 20 minutes to fill out once they know what they're looking at. Number 1 is Form W-4P, and it controls the tax withheld from your pension or IRA distribution. Here's the rule. When you set up a pension or start taking IRA distributions, the administrator usually withholds a flat percentage, often 10%, unless you tell them otherwise. That flat percentage has nothing to do with what you actually owe. It's just a default. Here's the dollar impact. If that default withholding is higher than your real tax bill, you're not being taxed more. You're loaning the government your own money interest-free until you file your return the following spring. Here's the example. Take a retiree named Frank, 66, single, in North Carolina, pulling $38,000 a year from a pension. His plan withholds the standard 10%, which comes out to $3,800 a year. But between the regular standard deduction, the extra standard deduction for being over 65, and the new $6,000 senior bonus deduction from the One Big Beautiful Bill Act, Frank's real federal tax liability on that pension is closer to $1,400. That means $2,400 a year, or exactly $200 a month, is sitting with the IRS instead of in Frank's checking account. Here's the common mistake. Most retirees never revisit their withholding after the first year. They set it once when they started the pension and never touch it again, even as tax laws change or their income shifts. Fixing this is genuinely simple. You download Form W4P from IRS.gov. Work through the short worksheet, which asks about your other income and deductions, and submit it directly to whoever manages your pension or IRA distributions. There's no waiting period, no approval process, no fee. Your new withholding typically takes effect the very next payment cycle, not the next tax year. If you've never once revisited this number since you retired, that alone is worth 10 minutes of your time this week. Now here's where it gets important, because Form number 2 works almost the exact same way, but for Social Security. Number 2 is Form W4V, and it controls tax withholding on your Social Security check. Here's the rule. Social Security does not withhold any federal tax by default. Zero. You have to actively request it, and when you do, you only get 4 choices: 7%, 10%, 12%, or 22%. Here's the dollar impact. This cuts 2 ways. Some seniors get no withholding at all, then owe a surprise bill every April, sometimes with an underpayment penalty attached. Others picked a rate years ago, back when their income was higher, and they're still over withholding at 22% when their real rate is closer to 10%. Here's the example. Consider a couple, Ruth and Daniel, both 70, in Arizona, with a combined Social Security benefit of $34,000 a year. Daniel set up 22% withholding back when he was still working part-time and their income was higher. Now, with the senior deductions built into the tax code, their real effective rate on that Social Security income is closer to 9%. That's roughly $2,200 a year, or about $183 a month, sitting with the IRS that should be in their account. Here's the common mistake. People treat their withholding choice as permanent, set once at retirement and never revisited, even though their income and tax situation change every year. Here's the fix, and it takes about as long as filling out a return envelope. Form W4V is available at ssa.gov, and once you know your rough tax bracket, you simply check the box for the closest matching percentage. You can submit it online through your SSA account, mail it to your local office, or drop it off in person. There's no cost, no review period beyond normal processing time, and you can change it again later if your income changes. Most people stop here, thinking withholding is the whole story, but the form built specifically for people your age hasn't come up yet. Number 3 is Form 1040-SR. The senior version of the standard tax return. Here's the rule. The IRS created 1040-SR specifically for taxpayers 65 and older. It's not a different tax law, it's a cleaner layout. But that layout matters because it includes a dedicated section for calculating the new senior bonus deduction from the One Big Beautiful Bill Act, up to $6,000 for a single filer and up to $12,000 for a married couple where both spouses qualify. Here's the dollar impact. That deduction phases out gradually once your income crosses $75,000 for a single filer or $150,000 for a married couple, and disappears completely at $175,000 single or $250,000 joint. For most retirees under those thresholds, this is a straightforward deduction worth claiming in full, and it lowers your taxable income whether you itemize or take the standard deduction. Here's the example. Margaret, 67, widowed, living in Tennessee, has a MAGI of $52,000. She qualifies for the full $6,000 senior bonus deduction on top of her regular and extra senior standard deductions. That's real money reducing what she owes, but only if her return actually reflects it. Here's the common mistake. Some retirees or their preparers still file the regular 1040 out of habit, and while the deduction can technically be claimed either way, the 1040-SR is built to make sure nothing gets missed. If you use a preparer, it's worth asking directly whether the senior deductions were applied and whether they show up on your return. It's also worth knowing this deduction stacks. You still get the regular standard deduction everyone gets. You still get the existing extra standard deduction for being over 65, which is separate and has existed for years. And on top of both of those, you now get this new senior bonus deduction from the One Big Beautiful Bill Act, as long as your income falls under the threshold. None of these cancel each other out. They add together. And the only way to make sure all 3 actually land on your return is to check that your preparer or your tax software software is using the version of the form built to capture them. Here's the part they never tell you, and it's the one that trips up anyone who's ever put money into an IRA that wasn't tax deductible. Number 4 is Form 8606, and it prevents you from paying tax twice on the same dollar. Here's the rule. Most IRA contributions are tax deductible going in and taxed once when you take the money out. But if you ever made a non-deductible contribution, meaning you contributed after-tax money, that portion is supposed to come out tax-free later. The only way the IRS knows which dollars were already taxed is if you filed Form 8606 in the year you made that contribution. Here's the dollar impact. If that form was never filed, the IRS has no record of your basis, and when you take distributions, the custodian reports the entire amount as taxable, even the part you already paid tax on years ago. Here's the example. Take Harold, 72, in Michigan, who made $30,000 in non-deductible IRA contributions over several years in the 1990s, back when his income was too high to deduct them. Nobody filed Form 8606 at the time. Now that he's taking required distributions, that $30,000 is being taxed a second time. At his current 22% bracket, that's roughly $6,600 he never should have owed. Here's the common mistake. People assume their tax preparer automatically tracked this. Most didn't, because the form has to be filed in the specific year the contribution was made, and it's easy to miss decades later. If this sounds like your situation, an amended return can sometimes still establish that basis, and that's a conversation worth having with a CPA. This one is worth double checking even if you're not sure it applies to you. If you ever went through a period, maybe your working years in the 80s or 90s, when your income was too high to deduct an IRA contribution, but you contributed anyway, that money should have been tracked from day one. A lot of people don't remember because it happened decades ago and the paperwork is long gone. Pulling your old tax transcripts from the IRS, which you can request directly, is often the only way to confirm whether Form 8606 was ever filed for you. And it's a 5-minute request that could save you thousands. Pay close attention here because form number 5 is the one with the biggest single monthly impact on this entire list, and it's tied directly to your Medicare bill. Number 5 is Form SSA 44, and it's your appeal against an inflated Medicare premium. Here's the rule. Medicare uses something called IRMAA, the Income-Related Monthly Adjustment Amount, to charge higher income beneficiaries more for Part B. In 2026, the standard Part B premium is $202.90 a month. But if your income crosses $109,000 as a single filer or $218,000 as a married couple, based on your tax return from 2 years earlier, Medicare adds a surcharge on top, pushing your premium up to $284.10 a month at the first tier and higher at each tier after that. Here's the trap. Medicare is looking at your income from 2 years ago, not today. If you were still working, sold a rental property, or took a large IRA distribution 2 years before you actually retired, Medicare may still be charging you the higher premium, even though your real income today is much lower. Here's the dollar impact. Form SSA 44 lets you report a life-changing event, and retirement itself qualifies, along with divorce, the death of a spouse, a work reduction, or the loss of pension income. If Social Security approves the appeal, they recalculate your premium using your current income instead of your outdated one. Here's the example. Take Carol, 68, in Ohio, who retired in mid-2024. Her income that year from partial salary plus a payout triggered the second IRMAA tier for her 2026 premium, pushing her Part B cost up by roughly $166 a month above standard. Her actual 2026 income is a fraction of that. She files Form SSA 44, checks the box for work stoppage, submits documentation of her current income, and Social Security drops her back to the standard $202.90 premium. That's close to $2,000 a year back in her pocket. And because she filed early in the year, some of it applied retroactively. Here's the common mistake. Most people assume a Medicare premium is fixed once it's set, and they never realize retirement itself is one of the 8 qualifying events that lets you appeal it. It's worth knowing all 8 because most people only ever hear about retirement. The qualifying events are marriage, divorce or annulment, the death of a spouse, a work stoppage, meaning you retired, a reduction in work hours, the loss of income-producing property like a rental you no longer own, the loss of pension income, and an employer settlement payment that temporarily inflated your income in a prior year. If any one of those describes something that's changed in your life since the income year Medicare is using, you likely qualify to appeal, and you don't have to wait for open enrollment. This form can be filed at any point during the year. Let's pull this together because 5 forms is a lot to hold in your head at once. Form W4P adjusts your pension or IRA withholding, available at irs.gov. Form W4V adjusts your Social Security withholding, available at ssa.gov. Form 1040-SR is your senior tax return, built into every major tax software. Form 8606 protects you from being taxed twice on non-deductible IRA contributions, filed with your annual return. And Form Form SSA 44 is your appeal against an outdated, inflated Medicare premium filed directly with Social Security. Notice the pattern running through all 5 of these. Every single one exists because your income situation in retirement doesn't stay fixed, but the systems tracking it often assume it does. A pension administrator assumes your withholding rate from year 1 still applies in year 5. Medicare assumes your income from 2 years ago still describes your life today. A tax preparer assumes the standard form covers everything, when a version built specifically for your age group exists. In every case, the fix isn't complicated. It's just a matter of someone telling the system that your circumstances have changed, and that someone has to be you, because none of these forms file themselves. If you only do one thing this week, start with Form SSA 44 if you're currently paying an IRMAA surcharge, because the monthly dollar impact is usually the largest, and the fix can apply almost immediately. You can find it by searching SSA 44 directly on ssa.gov. Download it and either mail it, submit it online, or bring it to your local Social Security office along with documentation showing your current income. If you're not sure whether you're paying a surcharge at all, look at the most recent letter you got from Social Security about your Medicare premium, or check your latest bank statement for the exact amount being deducted. If it's higher than $202.90 a month, you're paying a surcharge right now, based on income that may no longer reflect your life. After that, work down the list in order of what applies to you. If you're receiving a pension or IRA distribution, check your withholding with Form W-4P. If you collect Social Security, check your withholding with Form W-4V. Confirm with your preparer or your tax software that you're filing on Form 1040-SR so the senior deductions are captured correctly. And if you have any history of non-deductible IRA contributions from years past, ask a CPA about Form 8606 and whether an amended return makes sense for you. If this helped you spot even one form you'd never heard of, drop a comment and tell me which one was new to you, because it helps me know exactly what to cover next. And subscribe, because every week on this channel, we go through exactly this kind of overlooked rule, the kind that's completely legal, completely free, and completely up to you to claim. You worked for decades to get here. The paperwork that protects what you earned shouldn't be the part that gets forgotten.